Hello guys, welcome back to a brand new video on the Brazil FX trading. So in today's episode I want to teach you how we can draw Fibonacci retracement on our charts and then be able to find trades when you're trading the forex market. So the first thing is, if you're new around here, make sure to subscribe to this channel, turn on the notification bell so that you never miss out whenever I post a video. So today guys, we're looking at the Fibonacci retracement. First of all, what is a Fibonacci? Fibonacci is a sequence of numbers, It's a sequence of numbers, 1 to 10, that is just a sequence of numbers. And then Fibonacci was invented by Fibonacci. He was an Italian mathematician. So what does the word retracement mean? So whenever we have an overall trend of the market just like this, so let's say this is an uptrend, then this mere coming down, that is called a retracement. So we want to know how far will this retracement go, and then price goes back up. So this is what we want to look out for. So if you are someone who trades with the Fibonacci retracement, you can be able to find good trades of an uptrend market and a downtrend market. So I went first, demonstrate for you how do we trade with the Fibonacci, how do we draw it. So let's say this is our price going up like this. So this is our nice impulsive move, because remember, when we are dealing with Fibonacci, we are looking at impulsive moves and retracement. So where can we find nice impulsive moves? On the 4-hour time frame. Right now I'm dealing with the 4-hour time frame and I'm on the USD chef trade. So we want to see price shooting up with so much momentum like this, and then we want to see this coming. Whenever you see price starting to reverse, but when you know the overall trend of the market is an uptrend, then you can know where to or how to apply the fib, so you can see. So let's say this is our nice market, as you can see. So from here, so this is our starting line down here, as you can see right here. So price pushes up, starts coming back down. So this is an impulsive move, let's write it, an impulsive, I think just like that, impulsive. So we see price pushing up. I don't know if that's a spelling. I think so. Impulsive, yeah. That's impulsive, yeah. So impulsive, then this one is retracement. So let's write here retracement, just like this. So this is our nice retracement. Let's actually reduce the size to 10. Yes, so this is retracement, then this is the impulsive move right here. So traders, whenever you see something like that in the market, you know that we have a nice move, so you can apply your Fibonacci. So if you're applying your Fibonacci on an uptrend market, you come here, just here, then you choose this one, Fibonacci retracement, then you apply it from the swing low. So from the swing low to swing high, just like this. So this is how we apply the Fibonacci, traders. Now this is our nice uptrend market, so let's put it up here so that most of you see it properly, as you can see right there. So this is now a nice move right there. So we have price pushing up, then we see it coming down. Remember, this is an impulsive, then retracement. So we have so many important points on the forex Fibonacci retracement. So we have the 0.3, then the 0.5 and the 0.6. So what do we mean by this? From here to up here, this is 100%. As you can see here, starts from 1 to 0. So this is from here to here is 100%. So we want to know how much of the price will trace, like how much of price will trace and then go back up, how much of price will retrace and then go back up, just like this. So the most important points in the Fibonacci is the 0.5 level, the 0.6 level. These are the two most important points in the Fibonacci, and the reason for this is because price is most of the times retracing at levels where it has already been. So let's go now on our live market and show you. This is on an uptrend market. So this is our market right here, traders, as you can see. This is our market right here, even though everything has already happened, but I recommend you guys to go and back test. So this is our impulsive move from here to up here, then this is our retracement. So you're going to see where price retraced to, guys. This is our retracement. So let's apply the Fibonacci, and I want you guys to look at the point and then see where price so from swing low to swing high, just like this. So traders, you can see where price came back down to. It came back down to the 0.5 level. So let's draw a line there. Let's draw a line there. So this is the point where price retraced, as you can see. So if I remove my Fibonacci, you are going to see this is the 0.5 level, and the reason for this is because price was already here. It had already been here. So these levels on the Fibonacci, they act as support and resistance. So price found its support at this zone here. So this would be a best place to take your trade, and you'd be going in for the long positions like this. You measure out the distance between here. You measure out the impulsive move between this level, and then we are going to measure this. How many pips is this? This is 321 pips. So it's the same thing that it's the same thing here. Then the stop loss, we just risk just a small portion. Me, I like to risk 50 pips. If my target is almost over 300 pips, so I can risk 50 pips. So this is how you take your trade, guys. You take your trade when price comes back to the retracement. But again, sorry I didn't tell you the confirmation, but we always want to look out for confirmation of candles like the engulfing candle. As you can see, we have an engulfing candle in there. So if I do this and bring price there and zoom in for you guys, you're going to see price. This is an engulfing candle, as you can see. So this, and then you take your trade. So now let's try it out on a downtrend market. This is our USD chef. So this is the market that we started with. So when you're applying it on your downtrend market, you're applying the Fibonacci from the swing high to the swing low. So let's apply it. So the first impulsive move we have is this one. This is the impulsive move we have from here to down here. Then this is our retracement from here to here. So and most of you will see that, okay, price came really a bit close, almost it came back, you know. Yeah, I told you price only retraces to levels where it has already been. So let's apply our fib. You choose fib, apply from there to down here, as you can see. So we can even see price crossed over into the 0.6 level, but again I can see we had rejection, multiple rejection at the 0.6 level right there. Again, price only retraces in levels where it has already been. So this would be our most important zone here. This would be our most important zone. This would be our most important zone in here. So this is our most important zone, as you can see right there. So we delete this one. As you can see, traders, price only retraces in the zones where it has already been, as you can see. So confirmation, 1 2 3 rejection. This would be like a fake out. Take your trade there, measure out your target, as you can see. So if you have to measure your target, since we're going in for short moves here, you can take your trade here, put your stop loss just above here, and then we measure out our target like this, as you can see, traders. And you can see price never goes backwards. Here we are not only trading retracements, but we are trading with the trend of the market. This is a downtrend market, and we're only looking for sells. So you can even apply Fibonacci on this current market right here. You can see price, we have price doing the most impulsive here to there, and then you can see our retracement is here. This is the retracement there. So if we apply our Fibonacci, you're going to see that price only comes back to a zone that where it has already been, just like this. You can see we had a pin bar rejection at the same zone here. So let me draw out that zone for you. We had a pin bar rejection, and then also we didn't just have a pin bar, we had more of an imbalance. So price had to fill up that imbalance. As you can see, guys, price rejects this zone down here, up down here. So if we remove this, you can see, traders, we had imbalance in here. We had more of an imbalance in here. So this is imbalance there, and then also price comes back here first, and after it comes back here, fills up the imbalance, and then starts dropping. So probably you're going to be seeing sells on the USD chef. As you can see, price already started coming down. But again, this is the best way, traders, to trade in the forex market. And the reason why I'm telling you about the Fibonacci is because knowing about impulsive moves and retracements is one of the ways I had a breakthrough when I'm trading the forex market. just go to the daily time frame or the 4-hour time frame, look for your the trend of the market. When you know the trend of the market, now look for the impulsive moves. When you see a clear impulsive move, not every time you're going to see clear impulsive moves the way you want them. Sometimes they can be tricky. This is an impulsive move. You can see price comes back to the 0.5 level, have a pin bar, price comes down. So not every time you're going to see like very clear impulsive moves. You just have to be a minded person. But again, even though I didn't want to use impulsive moves, all I do is draw the trend of the market and then wait for price to retrace at my zone right here. You can see, traders, this is now adding some confluences. You can see, take your trade there, take your trade there, take your trade there. So also when you're using the trend, this trend line, you can know where retracements will come down to. Retracements always come down to the always retrace on the trend lines also. So you take a trade there, there. So next time we want to take a trade, we can take a trade off when the price comes down here, if you don't want to use the Fibonacci retracement. So traders, I hope you have enjoyed this video. Fibonacci, go back test it, go practice it, and I hope it's part of your strategy. Fibonacci can make you as much money as you want, traders. From here to down here, this is almost 200 pips. 200 pips time was a 10 lot size. That is crazy amounts of money, traders. That is almost, I don't know, it's almost $20,000 US. Imagine, traders, 200 pips. You're risking very less, and you can see price never turns back to take you out. So guys, if you've enjoyed this video, make sure to subscribe, and I'll see you in my next. Peace.